Hi, I'm Dan Pascone, CEO of Tailored Wealth and host of the Making Sense of Your Money podcast, real conversations to help high earners make sharper decisions so their money works as hard as they do. This is episode number 42, and today I'm joined by Peter Krull, partner and director of sustainable investing at Earth Equity Advisors, to unpack how sustainability and performance can coexist, why ESG is often misunderstood, and what makes a truly sustainable portfolio, and where the next big opportunities lie in infrastructure and biotech. Before we dive in, make sure you're subscribed on your favorite platform, and if you find the show valuable, I'd really appreciate you leaving a quick review. Thanks so much and enjoy.
Brought to you by Tailored Wealth, helping business leaders live their version of a rich life.
Welcome to another edition of the Making Sense of Your Money podcast, where we cut through the financial noise and help business leaders to make smart, confident money decisions. Peter, thanks for joining the Making Sense of Your Money podcast. Great to have you today, man.
Thanks, Dan. I'm excited to be here.
Yeah, I'm excited to have you, and this is a new topic for us, and one that I get a lot of requests and interest about, the idea of sustainable investing. So I'm interested to hear your thoughts and expertise on it. But as we always do, just start off by telling our audience a little bit about you, who you are, and how you got into this space.
Yeah, sure. So I've been in the business now in general for about 27 years. I started in 1998. Still blows my mind a little bit that I'm actually that old. But I started back in the
when
day.
You were 12 though, right?
I did. I started when I was 12. And I actually spray this gray hair in here to make me look older and a little bit wiser. No, I started with Merrill back in 1998. Cut my teeth there, learned the business from Merrill. Actually, I'll go even farther back. So my degree is actually in communications, not in finance or business or anything like that. And, doing sustainable investing, I think part of our challenge is always how do we communicate our value to clients? And so I think that's something that's actually worked really well for me. But yeah, I started with Merrill back in 98, did a stint there for about 5-6 years, did a very short stint at a bank and realized that the bank channel was not for me. And in 2004, I hung up my shingle using LPL as my broker-dealer and started what at the time was Krull and Company, but would eventually morph into Earth Equity Advisors. And at the time, I was dating the person over my shoulder here, who is my wife, Melissa, who is a lot smarter than me. She has PhDs in microbiology and molecular genetics. So I don't even touch that. But, we were having conversations about the environment and climate change and different things like that. And about the same time, one of my clients introduced me to a gentleman named Bill McDonough. And Bill at the time was considered like the preeminent green architect in the world. And so he was like developing cities in China. But he also had a book called Cradle to Cradle. And Cradle to Cradle is sort of a tome on circular economies. That idea that an economy shouldn't, when you have, say, an iPhone or something, when you're done with it, it doesn't go into the trash. You can break it down into its constituent components and use those to either, recycle or upcycle into a new product. So that idea of a circular economy where you don't have a waste in it is, was something we talked about. And not long after, talking to Melissa about this and having that conversation with Bill, I was like, I think I can do this. So I hung up my shingle, and that was 21 years ago this past June.
Very, very cool. So you and I share a previous stop. I was previously with LPL as well. So tell me a little bit about, there's a lot of financial advisors, a lot of wealth managers out there. What made you really want to focus on sustainable investing? And how does that actually come through in your practice today? Because I know you've got a couple of different offerings, both at the consumer level and at the business level.
Yeah, absolutely. Those conversations with Melissa and Bill really sort of set that in my mind. When I was at Merrill, I had one of our mentors in the office. Every time we would have a Calvert rep come in, he would say, I'm going to do that socially responsible investing thing. Okay. And he never followed through because he didn't really, it wasn't part of his ethic, if you will. But it just sort of, it was in the back of my mind. And when I had the conversations about climate with Melissa, when I had the conversations about circular economy and that kind of thing with Bill, I was like, I think that there's an opportunity here. And it was well before we had, the breadth of different, investment opportunities that we have now. And so it was hard trying to pick and choose what we were investing in. But over the last 21 years, what we have available to us has just really, really grown. The research has gotten better. The due diligence has gotten better. And the companies that are even available, like we've got a individual stock portfolio, and we're going to have to. I had it on do no calls, but we're going to have to do a
We're
stop.
busy people, man. It's all good. We're fitting this podcast into our daily business lives. It's all
Let me
good.
see if I can make this do not disturb. There we go.
There you go.
So, I forgot what I was saying there. Well, shoot.
You were talking about how you first got into and started to realize the breadth of options in the sort of
Yes.
systems.
So we've got an individual stock portfolio that is, we started in 2012, so it's 13 years old. One of the examples I give is there were no battery stocks back then, 13 years ago, and now there's a number of different battery stocks that I can buy into for that portfolio. That's just one example of how the market has really opened up to a more sustainable bent.
So let's start with sort of the foundational level, because I think oftentimes people throw these terms like sustainable investing, socially responsible investing around, but maybe don't quite comprehend exactly what that means. Can you kind of define what these terms mean for our audience that maybe have heard of them, but haven't really dabbled or gone all that deep?
Absolutely. So they've probably heard of two things. They've probably heard of ESG and SRI. Those are two things that are really in the lexicon today. So, ESG means environmental, social, and governance. And it came about from a paper related to the United Nations several years ago about how it would be good to start integrating this into the due diligence process. And so prior to that, there was less quantifiable data that was put into the due diligence process, and their contention was that if we get actual material data, it will make our process even better. And so that's where ESG comes from. What most people think ESG is not necessarily what it actually is, though. So, if you listen to politicians or if you listen to a lot of the media, you would think that ESG is basically rating a company's impact on the world around it. How is this impacting the world environmentally, et cetera? But it's actually just the opposite. So ESG risk is what is the ESG risk on the company. So what's the environmental risk on the company? And the example I like to give is, let's say you want to decide on two widget manufacturers. One of them has a manufacturing plant on the coast of Florida. One of them does not. And so that one with the plant on the coast of Florida actually has a material environmental risk associated with it because it gets hit with hurricanes, and there's a lot of opportunity for risk there. And so that's what ESG does, is it provides more information beyond just PE ratios and debt and profitability and all those things to help you look at things that are material, but just aren't typically counted with fundamentals. So that's what ESG is. Sustainable and let me go back. The way most investment managers like the BlackRocks of the world, Vanguards, et cetera, the way they create their ESG portfolios is they'll typically take an existing index, they will layer on top of it those ESG risk metrics, and they will make allocation adjustments based on those risk metrics. But ultimately, what you end up doing is, let's say we'll use Exxon as an example. It reduces the exposure to it, but it doesn't necessarily eliminate it. Instead of making it a sustainable portfolio, it actually makes it what I call a less bad portfolio. Which
Less bad. Okay, that makes sense.
There's nothing wrong with that.
You're not truly investing in sustainable if you're buying one of those funds.
Exactly. And if you're working with retail clients and a client comes to you and says, I want to own a sustainable portfolio, and you're like, okay, well, we got BlackRock, the price is low, it's one of the biggest in terms of AUM for these sustainable or ESG funds, and you buy them that, and then 3 months or 6 months later, they get their annual or semi-annual report, and like, well, let's look and see what we actually own. So they look at the underlying holdings, and they see Exxon and Chevron and McDonald's and FanDuel or whatever. They're going to be on the phone with you saying, I thought I asked you to buy me a sustainable portfolio. So from our perspective, a sustainable portfolio is more bottom up. It's asking the question, what are the industries and sectors and companies that are leading us into a cleaner, more resource efficient, more resilient, and more equitable economy? And how do we build a portfolio based on those metrics? And so that is how we look at sustainable investing. You can look at it from when we manage money in two ways. We've got fund portfolios, just conservative, moderate, aggressive, and then we've got an individual stock portfolio. So when we put our fund portfolios together, we are putting together just a good core, like you would for any modern portfolio theory: large cap, mid cap, small cap, international, emerging markets, et cetera. But what we complement it with is thematics. So the thematics would include energy transition, water, infrastructure. We use biotech and we use green real estate. And I think the interesting theme in that is infrastructure. And I'll tell you why. So we live in Asheville, North Carolina. And just about a year ago, a Hurricane Helene came through and did a ton of damage. People weren't expecting a storm of that intensity to hit 500 miles inland. It did. What we saw was a failure of transportation infrastructure, a failure of communication infrastructure, and a failure of utility infrastructure. And those failures are going to continue going forward as we have more intense storms. I know right now there's a big storm, as we're recording this in the Gulf, I think right now, Melissa, that is the most intense storm ever recorded. Those storms are going to continue to hit, and our infrastructure is going to need to be more resilient. It's going to need to be more adaptive, and that's going to take investment. And so I look at it not just as a risk, but also as an opportunity.
So that makes sense as far as where we're going. As far as the portfolios that you're building, whether it be for individual clients and investors or for firms to choose an investment, would you define them as 100% sustainable?
There is no such thing as 100% sustainable, realistically, because it's nothing but shades of gray. And there's no company that's going to be 100% green because it just simply doesn't exist at this point, and it probably never will. So when I look at thematics, it's really a matter of just trying to figure out where the economy is going. I mean, and at the end of the day, that's the definition of growth investing, right? Trying to invest in companies that are going to be market leaders, if not today, then tomorrow or the year after, et cetera, and getting in on those prior to them actually becoming the market leaders. But in terms of being 100% sustainable, no, we're really trying to make it as sustainable as possible. And realistically, I'd put our portfolios up against any of the others that are out there that are created.
Very cool. Very cool. All right. So tell us like a little bit about the types of either firms or investors that are attracted to your offerings, right? What are the conversations like with folks that are interested in the type of investing that you do versus all of the other big money managers that are
Yeah.
out
Well, it's a good thing from a marketing perspective because people find us a lot, so,
there? Right. It's
based on
niche,
what we
right?
do.
Yeah.
Yeah, I mean, it's considered although there's a joke that basically says, what do they call sustainable investing in Europe? Investing, because there's not that distinction between the two. But, the conversations that we have with people are really about what their values are, what's important to them. I mean, we standardize our portfolios and we are going to skew to the sustainable side versus the social side because there's more metrics that it's more metric driven. And I think we have a little bit more visibility. And it's also probably a little less politically unstable, too. I mean, the reality is no matter what happens in Washington, that companies know that if they're retrofitting their buildings, that ultimately it's going to be cheaper. So it's a bottom line issue for them. They know that from an economic perspective, putting in a solar field is a lot more efficient and a lot cheaper than building a new fossil fuel plant. And, we're continuing to see that, not just here in the States, but globally. And so that's a big trend. And so when we talk to people, we're telling them, here's what we see for where the economy is going, and here's how we sort of envision that we're going to be moving forward. We give them caveats because a true sustainable portfolio is going to be on the growth side of the growth value chart, if you will. So when we do run into a value bias like we did in, say, 21 or 22, we're probably going to underperform a little bit. But when we transition back like we have to the growth side again, we tend to believe that we're going to perform at or better at that point.
Got it. Makes sense. All right. So this show's all about making sense of your money. So explain to our audience, for those that may be interested in sustainable or socially conscious investing, whatever the case may be, how do you make money in this space? What are the things that you and your team are thinking about and looking at that maybe the average portfolio or stock picker isn't?
So when I started in this business back, 20 some years ago, we didn't have the fast access to data like we do now. And so it felt to me much more like we were working with long-term investors, and the more data has come and the faster the data has come, it's really almost transitioned to more short-term speculation at this point. Everybody wants to see what's rising today. It's the sort of the Jim Cramerization of the market, right? Here's what I want to buy today. But that's not what investing is ultimately. Investing is it's sort of like watching grass grow, right? It's, if we average 12% per year, theoretically, you should be making 1% per month. That's the idea. And so, when we talk about how you're going to make money, investing sustainably, it's about understanding the long term. It's about understanding that this is a paradigm shift that is actively happening right now. And while we're probably not going to, outperform every year, when you look at this over the long term, like any true investor is going to look at it, we believe that odds are you're probably going to perform at or better than the market.
Why? What makes you feel confident in that over the long period of time?
Because we have to at this point. The economy is shifting. Again, politics aside, companies are continuing to transition to clean energy. Companies are continuing to transition their workforce to be more diverse. They may not be tooting their horns now like they did 2, 3, 4 years ago. They're doing what's called green hushing, if you will. So they're continuing to maintain those operations. They're just not putting it out in press releases so that way they don't feel the political pressure to stop doing it. So when I look at, like, for example, if I look at the energy transition in the United States in 2024, 96% of all new energy plants and things that came online were either solar, wind, or batteries. That is not going to change. That now will be slowed down a little bit, somewhat, but that is probably going to be made up for overseas. China continues to be the leader in investing in new clean energy infrastructure.
Makes sense. How has maybe like the access changed since you started getting into this business and started to make this a focus for your clients and your firm?
It's night and day. The amount of funds out there, and a lot of the funds are greenwashed. So, you really have to
What does
be.
that mean? Explain what a greenwashed fund is.
Greenwashing is when you say that you're a green fund or a low carbon fund or an environmental fund or whatever label you want to put on it. But then when you look at the underlying holdings of it, they make you sort of scratch your head. Like I was talking about the BlackRock one earlier, that's got Exxon and Chevron and McDonald's, and trying to justify to me why you would put McDonald's in a socially or environmentally responsible portfolio, or again, any fossil fuel company. Our idea with not owning fossil fuels is I don't want to own both the problem and the solution. I just want to own the solution. And so that's what greenwashing is, and there's a ton of it out there, but in terms of what we have access to now, there's a lot more funds, a lot more breadth of availability, and some of them are really good. Some of them are pretty not great. But in general, Morgan Stanley had a report that came out within the last 2 months here saying that the first half of 2025, that sustainable funds outperform traditional funds considerably. So, and they're not picking out between the greenwashed and the non-greenwashed. They're just looking at everything across the board. But that just, that feels good to see that, to know that in spite of the sort of the negative political pressure we're feeling right now, it's actually performing even better. And we saw that if you go back to and I did this on my a client webinar last week, I showed 2 charts. I showed 2 4-year charts. One of them showed fossil fuels going up and clean energy going down, and one of them showed just the opposite. And I had people choose which administration was each one of those. Most people chose the one where where clean energy was going up and fossil fuels was going down, as the Biden administration, and it actually was just the opposite. So it just shows to me that, again, these trends are agnostic to what's going on in Washington.
And I think that's interesting, right? Because that would have been my vote as well, frankly, not knowing anything else. So that makes a lot of sense. So it's
That's
less
the thing, is it
about,
doesn't make sense, though, right? It
yeah,
doesn't make any sense. You would have assumed with the IRA and the infrastructure bill and all those things that happened during the Biden administration that clean energy would have vastly outperformed because all that money was flowing that way. It didn't happen.
yeah, it's wild. It's wild. All right. So you mentioned to me earlier that you predominantly focus on the public markets.
Yes.
Give our audience like a little bit of an understanding or an idea of what's the scope, what's the scale, what big is the breadth, how large is the breadth of investments that you actually have to choose from when your team is building a portfolio?
Yep. So when I'm putting our individual stock portfolio together, I've got a universe right now of about 750 stocks that I choose from.
Okay.
The only sector that we don't have in there is the fossil fuel sector, the energy sector. And that's an important distinction to make sure that everybody understands, is when you look at what is it, 7 or 8 different sectors in the S&P 500. When you see energy, that does not include solar, wind, batteries, geothermal, anything like that. That is only fossil fuels. Solar typically comes under the technology sector. Wind typically comes under industrials.
Okay.
Battery can come under either one of those, maybe even materials. So that, but energy is the only sector we don't hold in there. And a study by Jeremy Grantham's group several years ago went back, I think 50 years and even farther, and look to see if you took out any specific sector out of the S&P and ran its performance going back again, I think 25 and 50 years. Any sector you pull out, the delta between the worst performer and the best performer was less than 50 basis points. So pulling any one sector out does not necessarily negatively impact your performance.
Interesting. I know you focus on the public markets, but help us understand the difference in your field between the public and private markets, right? Because we've seen in general a shrinking of the public markets and more access from the average investor to the private markets. So how does that relate in the ESG or socially responsible investing space?
I mean, there's not a ton of private investments in general that are available in our space. You're going to find a few private investments that are focused on, say, solar fields or things like that that are privately held. There's more and more infrastructure that we're starting to see. Some of it solar, some of it batteries. Some of the things that I described earlier, like communications infrastructure, things like that. Those would really be the only areas that we feel like we might be missing out on, if you will, by just sticking to public markets. But there's also a lot of opportunities in the public markets to cover most of that, like from a HA sustainable infrastructure, which does a lot of solar and wind and energy efficiency development, to even something as simple as American Tower or any of these other cell companies, because again, there's a sustainability aspect on that, just simply from being able to stay in touch and the communications aspect of it, especially when I go back to our experience here in Asheville when we didn't have cell phone and or internet coverage for weeks at a time. You couldn't pick up the phone and see if your friend across town survived the storm. Those companies need to have that opportunity to build up their infrastructure in a way that's going to be positive for everybody.
Got it. Got it. Last one on this. What do you see as the big trends right now? Like, what are you thinking about 3 to 5 years out in this
Yep.
space?
I'm going to just keep coming back to infrastructure. I think that's going to be not just in this space. I think in investing in general, I think that infrastructure is going to be one of our biggest opportunities. I also like the biotech space, and I like the biotech space because of AI. The biotech for the last 3-4 years has just been horrible as a subsector to be in. But there's a number of companies out there now that are starting to integrate AI into their drug discovery process. And they can learn, from these large models, they can learn what works for certain people, what doesn't work for certain people. They can look at how particular drugs worked for a particular disease and then run that against in silico models and figure out, okay, there's a really good chance that this is also going to work for this disease. And the idea is that, it costs about $1 billion and takes a decade to bring a new drug to the market.
Yeah.
They think they can have that. And so those are two areas that we consistently look at. Water is going to continue to be an issue, especially in the West and Southwest. So how do we more efficiently use water? How do we make sure that everybody has access to water? Like you said, those 5 themes that we really sort of bolt onto, if you will, our fund portfolios, energy transition, water, infrastructure, green real estate, and biotech.
Very, very cool. On the biotech point, we actually had a biotech expert on the podcast a couple of weeks ago, and she was explaining the challenges that you just mentioned, right? There's a lot more losers than there are winners in the biotech space, and the time and dollars that it takes to be successful are astronomical. Well, if you can cut both of those down, you got a lot better chance to be successful. So that's an interesting thought. All right, very, very cool, Peters. I think that's a really great place to transition now to get to know you a little bit more. So we're officially going to transition into the lightning round, all right? So we never tell about the lightning round, and it's all about just the first thought that comes to your mind, whether it be a one-word answer or a long, drawn-out thought or anywhere in between. You ready?
Let's do it.
All right, start with an easy one. Coffee or tea? Okay, one meal for the rest of your life. What is it?
Pizza. I'm a Buffalo boy. I grew up in Buffalo, and we love our pizza up there.
So I used to travel to Buffalo a decent amount. Do you have a favorite spot that you liked in Buffalo?
Lenova's. I mean,
Yeah.
that's
Okay. Yeah. I've been
yep.
there a bunch. Yeah.
It's
Very
it's
cool.
the
Very
it's
good.
the char and curl pepperonis where there's that little puddle of grease sitting in the middle of
Yeah.
it.
Yeah.
So
Oh, yeah.
unhealthy, but so delicious.
So good. So good. I'm with you on that. I'm with you. I know Asheville has a pretty good food scene. That's a town
We
I
do.
haven't been to that I would like to get to at some point soon. All right. What's one tool or piece of technology other than your phone or your computer, right? Could be hardware, software, whatever, that you can't live without.
You know what? My Rivian truck is basically a computer on wheels. My EV, and I drove a Tesla and a Chevy Bolt before that, but I absolutely love my Rivian.
Okay, very cool. Very cool. Do you have a favorite quote or phrase about money, finance, or success?
I'm not sure that this is one of my favorites, but it's certainly one that came up like a week or two ago. And when my wife and I were chatting, I'm trying to think exactly how it goes. Is a foolish consistency is the hobgoblin of little minds. Falsely attributed, I think, to Ben Franklin or somebody. But it's the idea that we do what we always have done without really thinking about something
Yeah,
too much.
sure.
And all too often, and I definitely fall into this, we get really comfortable in our patterns and the way we do things. And I like the concept of what I like to call a nonlinear life. And so that way we aren't always just moving forward, that we're moving left, we're moving right, we're reassessing things. And that quote, I think, sort of embodies that philosophy.
Very cool. Very cool. Well said. I'm going to give you a chance here because I see you've got a book behind you, which I believe is yours. But do you have a
Yes.
favorite book that you would recommend to our audience?
I have lots of favorite books because I read somewhere between like 60 and 70 books a year. But my current favorite is The Sustainable Investor, which is now available on all your favorite, Amazon and bookshop.org and all these. Literally just came out yesterday. I was getting texts from people with holding their copy of their book. It's a book I wrote. It's published by Wiley,
Okay.
so it's not self-published or anything. They came to me and asked me to write the book and finished it. I finished it in March of this year, and it was actually supposed to be due at the end of last year, but I wanted to include Hurricane Helene into the narrative, and so it took a little bit of extra time, included that in there. And there's one thing that I actually haven't mentioned yet, and I'm glad you brought this up. So the traditional meaning of SRI was always socially responsible investing, and it evolved a little bit to be sustainable and responsible investing, but it needs to continue to change. And that's something that I talk a little bit, actually quite a bit about in the book, is that the S still needs to be sustainable. We need to reduce our impact so that way future generations can thrive just as much as we have. But the R needs to transition to resilience because, again, having dealt with Hurricane Helene, I was in Pacific Palisades a few weeks ago when I was out in California and just took a look at the devastation that was there. We need to be more resilient and we need to be building that into our portfolios. And then the I is innovation. Innovation will help us be more sustainable. Innovation will help us to be more resilient. And I think that's a new paradigm. It's a new definition of SRI going forward. And I think for investors, for people who aren't necessarily in this business, it's much easier to understand. It's a better story. It's a better way for them to really figure out what it is that we do. We're going to help you invest more sustainably, more resiliently, and with innovation. It makes a lot of sense. And I talk a lot about that in the book. The book is written both for financial advisors, but for the lay public in general. It gets into the history of sustainable investing in general. It gets into understanding what ESG is, how to actually create a portfolio, how to put together a universe like we have. And if you're a financial advisor, it talks about how to run your practice. How do you transition your practice so that way people aren't seeing you drive up in your Hummer? You might want to, change how you're using transportation. Yeah, can I give a website here?
Yeah, please. Please.
Yeah, it's if you go to sustainableinvestorbook.com, you can order it right from there.
All right, I'm going to go on and I'm going to order my copy right after this. It sounds like a good read. What's it like to write a book?
It's nonfiction, so it's about writing about what you know. And so the way I did it is I first broke it down into what I thought were basically like chapters and different topics that I wanted to cover. And as I was writing it, I would discover, oh, you know what? I need to add this. I need to add retirement plans into this. So that's going to go between what I thought was chapter 7 and chapter 8. So that's chapter 7A. And so I would create that file and start doing that. I cloistered myself away for 2-week long writing stints. So I went out to our cabin and I just sat and wrote for 2 weeks. Sometimes I would write 500 words in a day. Sometimes I'd write 3,000 words in a day. It just depends on how you're feeling and how it's flowing and what the topic is and stuff. I think one of the cool things is the actor Ed Begley Jr., who's been in all kinds of different TV shows and movies. He wrote the foreword for me. He's a long-term environmentalist, a friend of mine for several years now, and I asked him to write the foreword. He's like, love to do that for you. He also was the first guest on my podcast, so
Very
you have
cool.
to check that out too. Yeah.
I love it. I love it. Very, very good stuff. All right. Do you have either a routine or a personal hack that you can share with our audience?
So for the most part, I'm pretty good about going to the gym, but how I ensure that I go to the gym every morning, first of all, our office is on the 3rd floor of the YMCA. So if I don't go to the gym, there is no excuse, but
That helps.
my bag is packed the night before. That is
Me
what I
too.
do every day. That is my hack. I'm a big fan of Atomic Habits
Yep.
and the idea that you set yourself up for success by creating smaller sub habits, if you will, that lead to bigger habits and bigger outcomes.
I love it. I am an Atomic Habits fanatic myself, and I do pack my bag the night before. Absolutely. In fact, my wife just got me a like a stand that I could put my gym bag on because she was sick of me throwing the gym bag on the bed when I got home. So like pack it up. And I realized over the years that I never really understood it, but she may help me to understand why that wasn't the best thing to do. Anyways, all
They're
right,
good for
last
us.
one. If you
They're
could
good for us. They give us better habits.
yes, they do. Yes, they do. Indeed. Agreed. If you could give one piece of advice to your younger self, what would it be?
Um, I think I did this, but don't be afraid to make mistakes. I think so often our culture is averse to making mistakes. And the reality is we only learn from making mistakes. We don't necessarily learn from what we do right. We learn from what we do wrong. And so don't be afraid to try new things, to make mistakes. When I'm talking to, college or high school people and they ask what my recommendation is, I always say work in a restaurant because I worked in a restaurant for, a year and a half or 2 years during college. And you learn so many things that you need in the real world that you don't get in other industries. You learn how to interact with people. You learn how to deal with customers. You learn how to deal with angry customers. You learn how to get things done on time. There's so many things. I was lucky enough to have a bar and restaurant like 5 buildings down from my house where I grew up that, I worked there and enjoyed that. And I think I've carried that along with me.
It's good advice. Really, really good advice. All right, very cool. So you mentioned the book, but if our listeners want to connect with you, collaborate, learn more about what you do, where do they find you, Peter?
Yeah, you can just go to earthequity.com.
Okay.
And all of our information is there. Contact information is there. You can find the podcast, which is called Dollars and Change there. It's also on YouTube and Apple Podcasts and Spotify, I think.
Very cool. Well, we appreciate you sharing your insights with us today. Really enjoyed the discussion. Thanks for coming on.
Oh, Dan, it's been a pleasure. I've enjoyed it myself.
Amazing. That's it for the episode. You can find our podcast along with our newsletter and YouTube channel, all for free at makingsenseofyourmoney.com. And as always, prioritize your version of a rich life. Awesome, Peter.